Let me introduce myself. My name is Rory King. I am a second year finance student at Georgia Tech from Decatur, Georgia. My two stocks are JB Hunt and Qualcomm. Outside of this research, I'm involved as treasurer of Finance Society and I do GT boxing, and I have passed the CFA L1 exam. I enjoy watching TV, playing pickleball, and am a big Atlanta Falcons fan. Alright, let's talk about JB Hunt. JB Hunt is a transportation and logistics company based in Lowell, Arkansas, and founded in 1961. It is now the fourth largest trucking company in the U.S., and their vision is to create the most efficient transportation network in North America. JB Hunt has five distinct and complementary businesses, including intermodal, dedicated contract services, integrated capacity solutions, final mile services, and truckload. Intermodal is the largest division with a 100% 53-foot high cube contained fleet. Dedicated Contract Services offers value-driven supply chain solutions. Integrated Capacity Solutions matches customer loads with third-party carriers, and Final Mile Services handles delivery for big and bulky items from the last point in the supply chain to the customer's home or point of receipt. And Truckload, the last and smallest segment, is just full load, dry van freight. Okay, let's talk about Q2 2025. Earnings for Q2 2025 were roughly as expected given the current freight environment, with a marginal decrease from 2024, but functionally the same, and a slightly weaker in revenue and a slightly weaker operating margin as well. Revenue for Q2 was 2.93 billion, roughly the same. Operating income fell 4% from Q2 2024 to 2025, down to 197.3 million. Revenue stagnation resulted from an increase in overall loads, but higher medical expenses, driver wages, and equipment costs, which is what caused the operating income and margin decrease. Within segments, there was a 6% increase in intermodal load volume and a 13% increase in load volume for truckload, while a 9% decrease in integrated capacity solutions load volume and a 10% decrease in final mile services revenue impugned margins. In the conference call, management said inflationary pressures are responsible for the rising wages and equipment costs and predicted that final mile services revenue will continue to be muted. They expect second half performance to be similar to first half performance, but predict a cost decrease in 2026 and beyond. Management said that there is currently a freight recession, and costs and the situation are expected to improve as the freight recession lifts. JB Hunt also repurchased 319 million of stock this quarter, which is a positive sign. Okay, now let's look at the model. Revenue is roughly in the $12 billion range from 2023 or 2023 onward, and we expect it to be slightly increasing after 2025. As far as CapEx and free cash flow, I have a predicted CapEx as a percentage of revenue of 6% or 5% for the next few years, because freight is a very capital intensive industry and there will always need to be replacements and improvements to the capital. In addition, as demand rises with the subsidiation of the recession, they will need to purchase more trucks to be able to respond to the increased demand. Thus depreciation will also rise as CapEx increases and as the current fleet deteriorates. And so I expect free cash flow to increase as net income increases with revenue growth and lower costs, but be unaffected as much by the relationship between CapEx and depreciation. Cash as of Q2 2025 is roughly 51 million, which is roughly in line with the 46 million I had predicted before. Long-term debt stayed roughly the same, moving from 977 million to slightly over a billion with 1.019 billion. But short-term debt did increase significantly, going from 500 million to 700 million. As far as my predictions, I'm expecting a negative 1% decrease in overall revenue in 2025, which is roughly in line with the 1% decrease in first quarter revenue and equivalent Q2 revenue. And we have a conservative operating margin estimate of 6% for 2025, given the roughly 6.5% margin JB Hunt has had so far, but the poor environment and increasing costs given the macro environment. In 2026 through 2029, I expect revenue to increase significantly as the freight recession lifts, with either high single-digit or low double-digit percentage increases in 2027 through 2029 after a small increase in 2026. I also expect margins to recover and return to the 8 to 9% they were hovering around pre-2024. Yeah, I have a PE target listed as 18 given the current freight recession. And the intrinsic value of the model, based on all of this, is $144.01, which is slightly higher than the share price of $137.09. Given the expectations of a macro improvement for the freight industry, which may or may not be realized within the next year or two, and it would hurt JB Hunt if it were not to occur. I would describe JB Hunt as a hold and would neither recommend a buy or sell, even though the intrinsic value is estimated to be slightly higher than the share price.